Hello, everybody, and welcome to the Octa live trading session. My name is Ambrose Ebuka. Now, before I go over to talk to you guys about the content of today's trading session and discuss some of the amazing strategies that you can learn and give you guys an overall view of the market and potential future direction, go ahead and let me know your name in the chat and where you're watching me from. So you can go ahead and let me know your name and where you're watching me from in the chat. So some of the things you would learn today would be ways to analyze the markets, how we look at the news before opening a trade. We'll also look at some of the methods of opening and closing orders in real time. We'll look at steps of trading the markets. We'll do some analysis, look at some pairs. And in the course of this session, if you have any trading pairs that you want me to analyze, you can go ahead and type those pairs in the chat. And also, if you have questions that you want me to answer, you can go ahead and ask your questions in the chat as well. I'll be checking the chats to see if you guys have questions, and I'll answer them. All right, so Verma from India, thank you very much for joining. Iberici from Port Harcourt, thank you very much for joining. Welcome everybody, welcome to this session. So first, before analyzing the market, what I like to do, before going to the charts, what I like to do is to look at what's going on economically, well, in different countries. And the reason for that is because the economic stability or instability would have a direct influence on the domestic currency of a particular country. Now, what are some of the ways that you can get these economic reports? You can use the Octa economic calendar. So when you go to Octa's website, you come down to analysis and education, and under analytics, you click on economic calendar. And once you click on that, you'll be directed to this page where you can see some of the economic events that, let's see, some of the economic events that you have for the day. You can always change this using the time range tool. You can change this to tomorrow, yesterday, the previous week, next week, previous month, this month, next month, and all that. So just in case you missed out on any event, or you have a particular event that you want to look forward to, you can always take advantage of time range. Now, if you're a beginner trader, you can use the filter to include low impact and medium impact events to get knowledge. Just as the name goes, low impact events don't bring about volatility to the markets. Medium impact brings about medium volatility. High impact events bring about high volatility to the market. So just to get the knowledge of low impact events, like let's say business confidence regarding the New Zealand dollar, you can just always read this and know what it means, how it's going to impact this currency, even though the report is low. But at the end of the day, you get the knowledge about business confidence. There are also a lot of them, private sector credit, all that. And when you start to understand them, you can adjust your filter just like I do and focus just on high impact events. Now, how do you read the economic calendar? Remember, I told you guys that when you want to trade, you need to stay updated with the economic events of that day. You can also extend it to the week, just so that you're aware of what's going to happen for the end of the week. You're aware of the economic events that have been set before the end of the week. Now, to understand a brief way to understand the economic events would be, or a basic and introductory way would be to look at this reports you have here. Now, what do you have? You have the actual, you have the forecast, and you have the previous reports. Let's look at the first. So let's say retail sales month over month that influences or that regards the Australian dollar. Now, if you look at the previous, which was the previous report, it was at 1.1%. And again, this is high impact events. You can always set it from the advanced filters. So 1.1 was the previous, the forecast, which is, the reports that economists and investors have forecasted, or mostly economists and analysts, is 0.4%. And we have the actual, which was released today. This actual is the report after the news has been released, right? 0.3%. Now, if you look here, I got this information by just clicking on the report. You can just click on it and it drops down. Octa has provided a definition for the retail sales regarding the Australian dollar. And you can see down here that positive economic growth anticipates bullish trend for the AUD, while a low reading is seen as negative or bearish. So what this basically tells you is that obviously 0.3 is lesser than 1.1, right? And you can see that a low reading is seen as negative or bearish. Now, what do? You don't just take on this bias or this understanding and go to your chart and start selling the Australian dollar. No, you want to combine that with technical analysis. And by technical analysis, I mean key levels, key zones, market confirmation to enter at the best possible price. Let me know in the chat, how many of us know what retail sales mean? Retail sales, if you know what retail sales mean, or gross domestic product, or CPI, let me know in the chat. These are some really important news and really important reports that traders should take note of and traders should understand. Okay, so I'm just going to briefly go ahead and explain what they mean to you guys. So the retail sales, we're going to start with retail sales, refers to the purchases of finished goods and services by consumers. And the retail sales is a very important economic indicator because it reflects the overall spending behavior of consumers. And if you look at the GDP, the retail sales is a significant component of the GDP. Now, why is the retail sales important to you as a trader? It provides you as a trader insights into the state of the economy. It also reflects consumer sentiment and purchasing power. These are some of the importance of the retail sales. And we also have the gross domestic products, GDP. Oftentimes, if you look at if you read, let's say the market analytics that is being sent to your Octa trading app by expert traders, you'd see that most of the terms are abbreviated. You see something like GDP, CPI, NFP, and it's good to get acquainted with these abbreviations so you understand what they mean. So in summary, for the retail sales, it's important to you as a trader because it gives you valuable insight into the economic health, consumer sentiment, company performance, monetary policy, and also investment opportunities across various industries and sectors. And we have GDP, which stands for gross domestic product. So the GDP is a measure of the total economic output of a country. So the GDP represents the total value of all goods and services produced within the borders of a country within a specific time period. And it's usually measured, as you can see here, quarterly, quarter over quarter, or year over year. So it's measured quarterly or annually. All right, that's for the GDP. So if you don't know what it is, now you do. Which other important news do we have here? CPI. So for the GDP, to summarize the GDP, it's just, a key economic indicator, an important economic indicator that provides traders with the valuable insights to overall health, growth prospects, and the potential risk of an economy. Now, if you monitor the GDP data and the components of the GDP data or the reports, you can make more informed decisions regarding investments and risk management strategies as well. Finally, we have CPI regarding the Japanese yen, as you can see here. And this is also another information that I missed out on telling you guys. So if you look to the left, you'd see that these reports have the currencies that will be influenced by the reports. Okay, so you can see gross domestic product annualized, GDP. This one is going to influence the US dollar. This one is going to influence the pound. And if you look down here, you see the CPI is going to influence the Japanese yen. So also take note of that so you don't conflict your information. Now, the CPI, which is known as the Consumer Price Index. Another way to understand the definitions of these things is to click on each report and you'd see the definition right here. We have CPI that excludes food and energy. It's also known as the core CPI. And we have the normal CPI, which is the Consumer Price Index. And the Consumer Price Index is a measure of the average change over time in prices paid by consumers for goods and services. All right, they call it the measure of inflation, or the main indicator of inflation. It shows you how the cost of living is changing for consumers. All right, so that's just a brief explanation of this major events that we've had today. I've showed you guys how to read them. What we're going to do now is to go over the charts, and the charts are looking pretty interesting today. But what we're going to do is to look at it and analyze. And again, if you have pairs that you want me to look at, let me know in the chat. You can go ahead and type your favorite pairs and we'll analyze them together. So we're going to start with the dollar index. And the reason I start with the dollar index is because the reason I start with the dollar index is because most of the major currencies I trade are paired with the US dollar, right? So it's crucial for me to always check out what's going on with the dollar index, and I could flex that on some of the other pairs that I trade, some of the other currencies that I trade that are paired with the US dollar. Okay. So I told you guys that today we're going to learn, how to analyze the news and some of the steps that you can use to open an order or enter the market. And before I start to explain the zones that you have on here and some of the key levels that you have on here, we'll take the steps sequentially or chronologically, and we'll look at the market using those steps. Now, the first step, which we've already done, is to check the news. We've already done that. The second step is to understand market structure. The third step would be to identify our key levels. Now, with understanding market structure, you can use understanding market structure is basically being able to perceive the market, looking at the trends, being able to understand areas of supply and demand, just basically looking at the market and identifying the trend. And then you identify key levels that has to do with support and resistance zones, trend line support, Fibonacci levels. All that is included in step 3, which is identifying key levels. And when you identify your key levels, the next thing you want to look out for is what market does at that key level and your reaction to that. Now, your reaction to that would be identifying your entry. And for every trade that you choose to enter, it's important that you already know where you want to exit the trade prior to trade execution. So before you execute the trade, you already know where you want to close out in profit or where you want to close out to minimize your risk, right? So the 5th step would be your exit point. And the last step would be to apply proper risk management, right? Now, these are the things you need to identify before you execute the trade. And one of the beautiful advantages of this step is it eliminates emotion with trading. A lot of times traders come into the market and they just make rash decisions. They just want to go and buy or sell without having to conduct proper analysis, right? So if you follow these 6 steps, you can write this down or take note of these 6 steps. If you follow it, then one of the things you'll be eliminating would be emotion trading, making rash decisions, that rush that comes to trading. Because first, you've looked at the news, you understand on the fundamental aspect of trading, you understand the bigger picture, then you come to the chart, you understand what's going on, you understand the trend of the markets, you see if you're going to be trading with the trend or you're going to be trading in the opposite direction. The awareness has already been created. You identify your key levels, which are these zones that I have identified here. When I zoom in, as we analyze, you'd see the importance of key levels. You identify your entry points, you get your confirmation with momentum candlesticks. That's, you can even have multiple confirmations. The more the confluences, the stronger the confirmation. You can always add indicators like the moving average, the Fibonacci retracement to the RSI. If you use MACD, that's also fine. And your exits will be determined by, if you're new to trading, you can use the ATR indicator for your risk. You can use swings, candlestick swings, or market swings, depending on your trading style. So if you're a swing trader, you can use market swings. If you're a day trader, you can use candle swings, candle highs and lows for your exits. And the risk management strategy has to do with your risk to reward, which has to be moderate. And by moderate, I mean when you're choosing a risk to reward strategy, you're not going to be looking at risking 5% to make 1%. That's not moderate at all. So you're looking at the very least 1-to-1 risk to reward. And you just keep it moderate and simple. Use a conservative lot size, and use stop loss and take profit orders. Okay, so these are the 6 steps. I mean, you do this, you would have eliminated a lot of emotion trading, a lot of rash decisions and fears with executing your trades. Now we're going to look at the dollar index, and you guys will see a lot of these steps play out, and you see why it's important to follow these 6 steps, implement them into your trading. It just makes everything a bit simplified for you. All right, so we're on the monthly time frame on the dollar index right now, and it's also good that you start from the monthly, regardless of your trading style. You can start from the higher time frames. If you're a scalper, maybe you don't need to get to the monthly. You can start from the daily or the weekly, but it's just good to start from the higher time frames. Now, if you look at the monthly time frame, what you would see here is that, what you see here is that we have our trend line support that we've drawn all the way from July last year. And what has happened since the market came down to this support is that the market retested and bounced back up. Came here in December, couldn't break below, Actually broke below but couldn't sustain the break and pushed back up. Retested again in January, didn't break below. Almost came down to retest in March, and we are seeing a sudden takeover by the bulls in the US dollar, and you can see that the market, the dollar index is trading above our key level as we've identified here with this horizontal line. Just zoom out a bit so you guys can see why that is a key level for us. So you can see that this gray horizontal line serves as a key level because this is an area where price was rejected before. Well, it broke above here, but you can see that there was a struggle. It tried to break, couldn't, push back down a bit before it broke above. You can see the multiple struggles the market has had here. And again, you're seeing that the market is currently now trading above this level, right? If I zoom in closely, you see that this candlestick is pretty bullish. You can see the bullish takeover. I mean, the sales took this candlestick in March all the way down to this point. The buyers took over. You can see how they've been pushing this market all the way up to trade at this level that we've indicated here, right? So I'm going to go to the daily time frame so we can get more information on the dollar index. I'm going to have to take this out for a second so we can see properly. All right, so again, retest, couldn't break below, created this trend line support, broke below this trend line support, but we have an extended support area here that it didn't break below. So this was just a liquidity pool and a retest at this support that you have here. Just going to extend this all the way to the downside here. And now this has made this support level even more strong by this retest. So I've created a zone here just in case the market taps in again. I would know that I'll be looking for another bounce, and if we break below, then we're coming down here. So the one thing with key levels, and that's why it's also important that you identify your key levels, is that the market tends to move like a magnet. You know, the market tends to respect some of the areas where it has created support and resistance, it has created highs and lows before it continues. Most times we see a break, a sudden break that breaks below and just continues to push down, and that can be caused by news, you know, high impact news. But if you're talking about a trending market that creates high highs and higher lows, like an uptrend, you see the markets react to previous swing highs and swing lows, previous areas of supply and demand, before it continues to the trend or before you see a reversal. So what we're seeing right now is the market trading first above this support trend line that it failed to break, trading above some of our key levels that I've indicated here as well, and also trading above the 200 period moving average. But currently, if you can see up here, I'm going to zoom in and indicate that for you guys. Just indicate that around here for you guys so you can see how important this zone is to the dollar index, because a lot of times the market made a retest at this level. This was an area that the market found difficult to break below. We could see that we extended this from all the way in May last year. Couldn't break above, broke above finally and came back down to create support. Tried to break below, retested and continued to the downside, and you can see that this zone is just very important for the dollar index, and that's why we're seeing a lot of rejections. And even right now, you can see the dollar index is trading right at that zone, and we're seeing the rejections as well. We're seeing that the bulls are being rejected massively to the downside. We're seeing the formation of a long-legged doji candlestick. This level is a key level for us. It's an important level for the dollar index, and we need to look at if we'll get a reversal to the downside or a break to the upside. And obviously, if we get a break to the upside, then the next key level would be this point. I'm going to indicate that for you guys as well. Get the zones. Wait a second. 105. Now, if you're wondering how key levels work or why it's important to, or why market respects key levels, you notice that if you look at this chart, right? Let me zoom out a bit. If you look at this short area here, market created support. We're not going to do that. Let's stick to the most recent price action. So if you look here, you see the market created support, came back down to create support here again. It's only ideal that you identify this as a support level. Now, if you look here, you see that the market broke below all the way down. No retest, no consolidation, nothing. News events can cause that. And you see the break to the downside. What's the one of the things to look out for at key levels, or one of the hints or key points about key levels? One of them is that when the market is trading at a key level, let's say support area or resistance area, for example, you don't just go in once the market starts trading there. You need to see a confirmation. You need to see the candlestick. I told you guys the final confirmation you should get will be candlestick momentum. You need to see the candlestick show you. It could be a bullish engulfing or a bearish engulfing, could be a morning star or a shooting star, but the candlestick has to be your final point of your confirmation. That is what I use. So in a situation like this, let's talk about something like this. Because there was no confirmation here, there was no rejection, the market just broke down below. It wouldn't be ideal to just start placing buy limits here, and you start saying, well, if the market gets here, it's going to push back up, and what happens? You see that you would have been stopped out of this trade if you placed a buy here, right? You see that the market just continued to push all the way to the downside. So again, you need to see rejections. You need to see the candle. You need to use candlestick confirmation as your last point of, or candlestick momentum as your last point of confirmation. You can combine that with, you know, moving average breaks, moving average bounce, RSI divergence, whatever it is you want to combine it with to give you multiple confluences. You just have to look at the momentum of the candlestick to say this is when I want to enter. Now, in a situation like this, we did not see any pullback or any rejection. It was just a straight break to the downside, the follow up to the downside. It was around areas like this that we started to see the bullish candlestick form, started to see bearish candlesticks reduce, doji candle, long-legged doji on, and you see the bullish candlestick starts to form and take the market all the way to the top. We had the breakout here, we had the retest, another rejection. So these are some of the things that you want to look out for, not just, oh, the market is trading at a support level, let me buy, trading at a resistance level, let me sell. You want the market to act, and what you do as a trader, because you're not the one that controls the market, so what you do is to react. All right. Okay, so why did I give you that illustration? Because the market is trading at a key level right now. You can see this zone identified, rejected twice, 2 times here again, and now the market has been rejected in that zone. 1, 2, 3, 4. 1, 2, 3, 4, 5. In the last 5 days, the market has been trying to break above this zone, but it's been rejected, right? So we can't say for now that we should start buying or selling the dollar, because we don't have any clear indication that this is going to be a continuous recovery or a continuous bull run for the dollar index. But what we want to do is to observe how the market reacts to this key level and trade in that direction. Now, if the market were to pull back down from here, the most recent swing or the most recent area is going to come retest would be this level. I'm going to have to increase that. Yeah. We also have this one as well. We could pull back into this zone before it tries to break out from this resistance again. Also pull back into the zone as well. But we're not trading the dollar index. It's not paired with any currency. We're only using the dollar index to see the strength or weakness of the dollar. And we can now go over to currency pairs like GBP USD, Euro USD to trade what the dollar index, to trade the strength or weakness of the dollar index. All right. So right now, again, trading at a key level, we're seeing indecision candlesticks form. What that means is that we're not certain if we're going to get a break here or a pushback to the downside. We'll just have to wait and see how the market reacts to this key level. And if you go over to pound dollar or euro dollar, you'd see the same thing. The market is trading at key levels as well. Let me zoom out. Okay, someone is asking, please. So the candlestick is everything you're seeing here right now. We have multiple forms of charting system or multiple charting types. We have the candle, we have the bars. This is the bar chart. It's a candlestick chart. We have the hollow candlestick chart. We have lines with markers, steep line or step line, area, just a lot, right? But the candlestick chart is the mostly used or the most common that is being used by traders in the market. And what this means is that we are on the daily time frame, as you can see up here, 1 day. And what this means is that each candlestick here opened and closed within 1 trading day. Each candlestick here. So if you look here, you see a lot of candlestick, you see blue and white. Now it's typically red and green, but I changed this a long time ago. So it's typically red and green. If you open your chart, you'd see red and green, or you see white and black, you know. And for this chart, the blue signifies the bearish, the white signifies the bullish, right? The bullish candlesticks. So just to explain what candlesticks are, there are these things you're seeing on your chart. And if I zoom in, you see some candlesticks are longer, which signifies momentum. Some candlesticks are shorter like this, which doesn't signify momentum or shows you indecision candlesticks. Just like this, you see all these candlesticks that have here. These are not momentum candlesticks. If you want to look out for momentum candlesticks, you're looking out for candlesticks like this, you know, engulfing candlesticks like that. All right. So again, each candlestick here, because we're on the daily time frame, it tells you that each candlestick here opened and closed within a trading day. If you change the time frame to, let's say, the 4-hour time frame, right, you see that the pattern changes. It could still be the same trend slightly, but the pattern just changes because now we are going even lower. We've moved from a day to 4 hours. So we're going to have more noise. We're going to have more candlesticks. And what it means is that each candlestick here opened and closed within 4 trading hours. All right, 4 hours, as you can see. Now, let me just zoom in closely so that I can show you how the candlestick. So let's say this candlestick, for example, this white candlestick. How do you understand what this means, right? First, the candlestick closed as a bullish candlestick, which means it closed above the opening point. Now, a bullish candlestick opens below and closes above. A bearish candlestick opens above and closes below. The shadows that you see here, these lines that are like straight, we call them wicks in the Forex market, W-I-C-K-S. They tell you, or they show you that at some point between the opening and closing time of this candlestick, the market came down to this point, but it pushed back up. That movement that the market came down to this point has left you with a trace. It leaves you with a shadow. It's like a footstep. So let's say you're walking, you open here and you come out and you walk, you walk all the way down to this point. For some reasons, you start to turn back and you go back up all the way to this point. What happens? Your footsteps or your footprint will be left here so that someone can come and see, oh, he went here, but he turned back and he went to the top side. Something might have happened, right? What happened? The sellers were in charge. They couldn't sustain that momentum and the buyers pushed them all the way above the opening point and closed above the opening point. So that's how you read a bullish candlestick. The bearish candlestick is the same, but just the opposite. So let's look for a bearish candlestick. Let's say a candlestick like this. Remember, the bearish candlestick opens above and closes below, right? So opened here, the buyers were in charge at some point. You know, they walked all the way to this level. They couldn't sustain that push to the upside. And what happened? The sellers took over, pushed them down below the opening point. Right? This is where the market opened. If it closes bearish, then you know that it opened above. The sellers pushed them down. It has left you with this trace, this straight line that you see here. Let me see if I can use this to indicate that. Okay, gotta change the color. So you see this arrow pointing towards the straight line. That's the trace. It's called a wick. Let me spell that for you guys quickly. Called out a wick, right? So sellers pushed the market all the way down to this point, came to this point, but the buyers pushed it up a bit to close here, and that's why you have this wick created down here as well as a footprint, as the indication that, oh, the sellers pushed this market all the way down before the buyers closed up above. So let me know in the chat. Emmanuel, you asked the question about candlestick, so let me know in the chat if you understand candlesticks now. Just gonna have to delete this. All right, so looking at what's going on currently with pound dollar, let's go to the daily first, and then we can come back to the 4-hour time frame. All right, so clearly you can see that we have support trend line drawn across, you know, the swing lows of this assets, the pound dollar on the daily time frame, and you can clearly see the importance of key levels. Let me show you guys quickly. Let's emphasize on the importance of key levels. Obviously, we have support here. This is a key level because you see the reaction of the market to the support level. 1, 2, 3, 4. If I even go all the way back, you see one here. I can extend to these levels as well, but let's stick to current price action or recent price action, right? Now you see that this trend line, this support trend line, was drawn across the lows, the swing lows of the pound dollar market, and you'd see that for every time the asset came down to this support level, we had a retest. We successfully broke below it, came down to this key level, this key support level that we've drawn all the way from November 22nd last year. The market couldn't sustain that break, made a retest at the trend line support and started to push back down. But because we're looking at a key level, right here, guys, we're not just going to see a retest and push back down, boom, 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 just like that, except we have a major news event. The market is going to react to this key level, which it is doing right now. And then if we get a break below, then we're coming down to make a retest at this zone, right? If we get a break below that, then we're coming down to make a retest at this level, which is also going to give us that nice break below the 200 period moving average like you have here. All right. So trading at a key level, again, we want to see what the market does. We could see a bounce to the top, a rejection, and then a bounce to the top, and you see the market starts to trade above this support area that we have here. Because obviously, if you look at the pound dollar market, you notice that for a while now, we've been consolidating within this zone, right? We've been consolidating within this zone since November last year. You see the market has been consolidating, but it doesn't really mean that you can't make profit from a consolidating market, because you can always buy and sell at the support and resistance levels, right? A ranging market can still give you a profit, just like a trending market would. But with the ranging market, it's kind of limited, because now you know that if you're going to be waiting for this market to get here, let's say, let's do this. So let's say you're waiting for the market to get here, so you can look for buy opportunities that you can target this level. If you see some rejections and a breakout, retest, you buy again, add more positions, and then we're targeting this level next, right? It's kind of limited, because now when you start buying here, when you see confirmations, your targets would be this level, because obviously for the market to get here, it has to break this point first. And we're looking at about 100 pips. But in a trending market, when you see from a swing to the next swing, it's usually much in the amount of pips. From a swing to the next swing. Let me zoom out a bit and see if I can show you guys. Okay, I think we have one here. So let's say that you want to trade this market, right? We're seeing series of lower lows and lower the chart. Let me know if you guys can still hear me in the chat. All right. So a trending market gives you the flexibility to, play around with support and resist, with stop loss and take profit levels. You have more defined stop loss levels. You have more defined take profit levels. Let's say, for example, right, zone, and we're seeing the market we're seeing the buyers find it difficult to break above. You're seeing all the indecision candlestick and the slowed momentum at this point. A good place to set my stop loss would be above this high of this candlestick, right? And that'll give us about 65, let's just call it 70 pips stop loss. And if you're looking at the take profit, the most recent swing would be where? This is the most recent swing. Now, compared to a ranging market, you have a refined stop loss, you have a longer swing to the downside. Now you guys see that. So we're looking at a 1-to-6 risk to reward ratio, because we're looking at 400 pips approximated profits that can be made, because obviously if you're trading a sell at the rejection of this key level, our most recent swing would be here, right? Let me show you guys what I'm talking about. If I'm trading this sell, if I'm looking to sell this market here, because I'm already seeing the rejection, I'm seeing the buyers being rejected, I'm seeing the struggle to break above this key level up here. So if I'm looking to sell, boom, the next key level I'll be looking at would be this area, this level down here, right? I indicate that, and what does that give me? It gives me a nice 1-to-6 risk to reward ratio. So that's just one of the benefits of trading a trending market. It's more, you're more flexible, you're more relaxed and comfortable, you have more room to swing trades, to trade the trend until it bends, right? And now you can see that I could easily take profits here. If I have open positions running, then what I do is to put my stop loss into profit. And when I see some pullbacks in the market, I see how the market reacts to that pullback. For example, I'll be looking at levels of internal liquidity, like areas like this, where I expect the market to tap in, reject, and continue to push back to the downside. So when I see areas like this, I can decide to place even more sell trades there. And what happens? The market starts to trade even down. So that's one of the ways that you can take advantage of a trending market. Again, you can always take advantage of a ranging market, but the trending market gives you more opportunities. And you know that with trading, you're looking for the best possible opportunity to trade. You're looking to trade at the best possible price and feel more comfortable with your trades. All right. The same thing with Euro USD, still at a key level as well. But one of the interesting things about the Euro USD on the daily time frame is that we're seeing the market form some kind of apex, right? We're seeing the market move in a narrow manner. And usually when market trends like this, what we get to see, when the market trends like this, boom, 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 something like, I have to take that out now. So when you see something like this, retest, bounce, connect another word. It's just evident that there would be a breakout on this asset, on Euro USD, because when the market moves in a narrow manner, especially when you have key levels even drawn inside that apex, there's always going to be a breakout from this arrow that has been formed there. You can see it's forming like an arrow, like moving in a very narrow manner. There's always going to be a breakout, either to the top or to the downside. Now, if we get a breakout, let's say we have two key levels, as you can see now. We have the support level here, and this is a key level because we can trace it all the way to the all the way to September last year. We have our resistance level, which is also a key level that we can trace all the way back to, we can even trace it all the way back to January last year, right? So this is pretty significant for us. If we get a break above it, that's also going to be a break above the trend line resistance that we can see here. That's two breaks that we have on there. If you get a retest and a rejection, then we're coming all the way to grab external liquidity from this point before we go down and start to trade to the downside. So regardless of where the market goes, if we get a break to the downside, we can always capitalize on that. I believe that if I'm to look for sell opportunities on Euro USD, here's what I'm going to do, right? I have this level that I want the market to break out of. If the market breaks out of this level, I'm not going to sell until we have a break and a possible retest out of this zone. Then I can start trading Euro USD all the way to this point, right? But we have to break below this level first, because what we could see is the market could just tap in here and boom, see the market push back to the upside. And because this is a key level, a lot of traders would want to enter here, or the market could even go lower. We could see the market extend even lower to this point. Before it pushes to the top side. So we want to be very careful how we react to these key levels. Again, you want the market to give you the confirmation with candlesticks before you start to execute your trades. So that's what I want to look out for on Euro USD and GBP USD. We are at key levels right now. We want to see how the market reacts to those key levels. I've shown you guys some of the possible directions the market could go. And one way that, so that you don't just miss out on this move, right? Because oftentimes we make analysis, and when the market gets there, because we want to execute the trade instantly, we just miss out on the move, and we start to feel bad. So one thing you can do is to take advantage of the Octa pending orders that we have here. So if you look here, you can see Euro USD, GBP USD. You can click on pending order and put in the value or the price that you have on your chart where you've done your analysis. If you did your analysis here, nice, you can just put in the value on here. You can type whatever value it is. It can be a buy limit, a sell stop, or a buy stop and a sell limit. That way, you've placed the order at a future price. So if the market gets there, you won't miss out. It's going to execute automatically, and your trade will start running. All right. So you can come back to see that profit or trade running against you. So right about now, I'll go ahead and answer your questions if you guys have any. I'll go ahead and answer your questions. So if you have any questions, this is the time you let me know your questions in the chat. And I'm checking the chat right now to answer your questions, guys. What's the minimum amount I can start with? Well, the minimum deposit with Octa is $20. But that doesn't mean that that's the minimum you can start with. Your minimum is relative to a lot of people, So I think it's dependent on your risk tolerance. Your minimum can be 100, your minimum can be 200. It depends on your risk tolerance. Yeah. But the minimum deposit with Octa is $20. And if you want to take advantage of risk to reward, like risking 1%, all that, or 2%, then I just have to tell you that a $20, a 1% risk on a $20 account is 2 cents or 20 cents, right? And the market only has to move 2 pips for your 20 cents to be taken out. So if you really want to take advantage of risk to reward and take advantage of, give the market more room to move, then you're going to start with something that can give you that space, that flexibility, which is going to be higher than $20. If you guys have any other questions, you can let me know in the chat. What's the best way to understand the chart? Well, there are a lot of strategies that you can use to analyze the market. And when I mean a lot, I mean a whole lot of strategies that you can use. But one of the simplest ways is to identify key levels on the chart, key zones, identify the trends before any other thing. Right? So you want to look at the trend, look at areas of supply and demand, look at potential pullbacks and continuation patterns. Those are some of the important things, and then you start to look for liquidity areas, candlestick momentum, and all that. So one of the best ways to understand the charts is, again, a simplified way, looking at the trends, because the trend gives you the direction of the market. Where is it going? Is it headed up? Is it headed down? The trends will tell you that. Are we seeing a reversal from an uptrend or a downtrend? The trends will tell you that. Your key levels will tell you this is where the market would potentially stop before it continues to the top side. This is where the market could potentially retest before it continues to the up or the downside. Key levels tell you that. You can also use the Fibonacci indicator for that as well to trade pullbacks and continuations. Fibonacci level is good for that. Because I would love to be good trading gold. Well, practice makes improvement. Okay, and talking about practice, Octa has a free demo account that you can take advantage of. You can use that to improve your trading abilities. The demo account is free. If you check the link in the description of this video, and don't click that right now, you can click it after the video so that you don't leave the session. So after the session, you can click the link where it says start trading. Click on the link. If you don't have an account, you can go ahead and create an account. It takes literally 2 minutes to do that. Then you create a demo account, which is like a practice account where you can practice your trades and, you know, get better at gold. I'll give you a quick tip, an important one with demo accounts, right? So when you want to start trading a demo account, it's good that you start with an amount that you can use on a live account. Okay, so if you start trading the demo account and you start trading with $100,000, and you know you won't start trading on a live account with $100,000, then when it's time to switch to a live account and you start with 1,000, you might find it difficult to transition. Even with the profits, with the demo account, you could be making $10,000, $30,000. And when it comes to your live account that you're trading $8,000, then you start to put a lot of pressure on the $1,000 to give you the same profits the $100,000 was giving you, just because you're not familiar with, you know, the trading differences. So it's good if you're going to start with 1,000 on a live account or 2,000, then you start with that on a demo so that when you transition, it's not much of a difficulty for you. All right, guys, I guess that'll be all the questions you have for me today. If I didn't answer any of your questions, I think I can't see any more questions here. But if you're just watching and you have more questions, you can go ahead and type your questions in the chat. The questions would all be answered. Thank you guys for joining this session, and I will see you guys in the next one. Bye, everyone.